I'm Matt Bouchard with REIT.com, and I'm here in New York City for REITWeek 2012, NAREIT's Investor Forum. Joining me today is David Neithercut, President and CEO of Equity Residential. David, Equity Residential's bid for a stake of Archstone earlier this year caught the industry's attention. What was the company's goal with this transaction, and where do you turn now?
Well, as you know, Archstone owns a terrific portfolio of high-quality assets in our core markets across the country. And a dysfunctional governance situation between the banks and the Lehman estate, and a difference of opinion of those partners as to where to go with that portfolio created an opportunity for us to insert ourselves in the process to see whether or not we could play some role in the ultimate outcome. At the end of the day, it wasn't to be, and the banks got liquidity for their position, the estate got control, and Equity Residential got paid $150 million for the value that we created from the position that we took. So we're disappointed that nothing came of that, but the consolation prize wasn't so bad. So today we just go back to what we've been doing over the last 10 years, and that's selling assets in non-core markets and taking that capital and trying to reallocate that in the markets that we have been focused on, the high density urban markets across the country.
And did the end result say anything to you about the current market climate or the demand for these high quality assets?
Well, you didn't need this situation to tell you that there's a great deal of demand for the high-quality assets that EQR owns and has been buying, and Archstone's as well. What it really said was how much the Lehman estate wanted control of the portfolio. They wanted to rid themselves of their partnership with the banks and have ultimate control. And who knows where it will go from here. But certainly those types, the types of assets, the quality of assets that Archstone owns, as well as what Equity Residential owns today, the market is valuing very, very nicely today.
And there have been many factors driving the strong results in the multifamily sector. Among them, of course, has been the weak housing market. And as that situation improves, or if the situation improves,
if it improves,
are there certain markets that are rental markets that are more susceptible to a recovery in the housing market? And how do you plan for that?
Well, certainly those markets where the cost of single-family housing is low, those markets will be more impacted by the resurgence, if you will, of the single-family market. So what we've already seen, for instance, in this past quarter, increases in the percentage of our residents are moving out to buy homes in Phoenix and in places in Florida and Atlanta, et cetera. But in those markets where single-family house prices continue to be very, very expensive, where there are markets in which our residents can't afford even those prices, or aren't interested in taking on the burden of single-family home ownership. And the way one prepares for that is the way we've been preparing our portfolio for quite some time, and that is selling assets in those non-core markets and allocating our capital into those higher barrier, high-density markets in which the cost of housing, be it single-family or rental, is the highest. And we think that in doing so, we'll be very well protected over the long term. We have very high occupancies, we've got strong demand for our properties, and we're just not seeing people move out to buy single-family homes anywhere near the rate that they had in the past.
David, thank you so much for joining us.
My pleasure. Thanks for having me.
For more on this and other news and analysis, be sure to visit REIT.com.